Did you know a $180K Costa Rican beachfront condo now pays 12% rent? While a Manhattan penthouse barely hits 3%, the ultra-rich are quietly flipping coasts. Stay tuned. Welcome back to Latam Money Secrets. I'm Alex, and today we're peeling back the curtain on a wave that's reshaping the luxury real estate map. Picture this. You dropped $50,000 into a Costa Rica beachfront condo back in 2019. Fast forward to 2026, and that same unit is trading around $70,500, a 41% jump according to local central bank data that mirrors the ILF ETF. Past performance does not guarantee future results. Year-to-date surge. That's not luck, it's a structural shift you can ride. In the next few minutes, you'll learn 1. How Costa Rica's macro backdrop translates into real-world buying power for investors like you. 2. Which 3 high-growth sectors are fueling the condo boom, and how their returns stack up against traditional U.S. assets. 3. The exact price gap comparison that shows why a $180K beach condo can out-earn a $800K Miami high-rise. Grab a notebook. The details coming up could reshape your portfolio. Costa Rica posted a 358.7 billion GDP in 2025, growing at a solid 3.7% annual rate. That pace outstrips the United States, which is hovering around 2.1% growth, and it's faster than the Eurozone's average of roughly 1.5%. For an investor, a higher growth economy means expanding consumer spending, more jobs, and a broader tax base, all of which underpin property values and rental demand. Inflation is another linchpin. At 4.3%, Costa Rica sits just a whisker above the US 3.1% and the UK's 3.4%, and well below many emerging markets that flirt with double-digit rates. A moderate inflation environment protects real returns. Your rental income won't be eroded overnight, and you avoid the hyperinflation scares that have plagued neighbors like Argentina. Foreign direct investment may look modest at $9 billion, but that figure is deceptive. While the capital inflow is small, the market's efficiency is evident. The ILF ETF, past performance does not guarantee future results, which tracks Costa Rican equities, has surged 41.12% YTD, lifting its price to $34.07. $1 number blew my mind. A modest FDI stream paired with a 41% equity rally signals that investors are pricing in far more growth than the headline cash flows suggest. Contrast that with France's 2.8% inflation rate. Costa Rica's slightly higher price pressure still leaves room for real estate yields that comfortably beat European benchmarks. In short, the macro data paint a picture of a stable, expanding economy that offers a sweet spot between growth and price stability, the perfect breeding ground for high-end beachfront assets. While U.S. investors scramble for the last slice of the S&P 500, a quieter, more lucrative arena is opening up on the Pacific coast. The first insider secret: renewable energy infrastructure projects, solar farms, and hydroelectric plants are being bundled with condo developments, delivering an estimated 8-12% annualized IRR. Investors who lock in a 10-year power purchase agreement can count on predictable cash flow, and the green badge adds premium appeal to beachfront rentals. Second, eco-tourism is exploding. Boutique hotels and boutique-style condo hotel hybrids are fetching 10-14% yearly returns, driven by high-spending travelers seeking sustainable luxury. A single 2-bedroom beachfront unit, built at a cost of roughly $180K, can command nightly rates of $300-$350 during peak season, translating to a gross rental yield north of 12% after accounting for management fees. Compare that to a Miami condo that costs $800K and typically yields 4-5% after expenses. The Costa Rican option delivers 3 times the cash-on-cash return for a fraction of the capital outlay. Third, technology-enabled agribusiness platforms are attracting venture capital, promising 9-13% ROI. These platforms lease land adjacent to coastal properties, creating a mixed-use ecosystem where guests enjoy farm-to-table experiences while investors tap into agricultural profit streams. Put the numbers together. A $180K condo delivering 12% rent nets $21,600 annually. Add a 2% ancillary income from a renewable energy share, and you're looking at $23,500 before taxes, a total yield of roughly 13%. Multiply that by a portfolio of 5 units, and you're cruising past $100K in passive income with less than $1 million deployed. The price gap, the yield differential, and the macro tailwinds make Costa Rica's beachfront market a high-conviction play for anyone ready to move beyond the overcrowded U.S. core. The ultra-rich have already begun shifting their capital. The question is whether you'll join them. John had been scrolling the luxury condo feeds on Instagram when a friend in San Jose sent him a link to a new development on the Pacific Rim. The project sits on a 2-hectare parcel just north of the bustling beach town that locals call the Riviera, a stretch where the sand is white, the surf is world-class, and the government has earmarked a 10-year tax incentive for hospitality-linked construction. John's calculator showed a total outlay of $2 million for a 180 square meter, 3-bedroom unit. The price per square meter hovered around $6,700, a figure that feels like a bargain when you compare it with the $12,000.15,000 USD pay for a comparable beachfront condo in Miami South Beach, or the $13,500 per square meter quoted for a premium unit in Sydney's Bondi. In the UK, a similar property in Cornwall would easily breach £9,000 per square meter. What sealed the deal for John wasn't just the lower price tag. The ILF ETF, past performance does not guarantee future results, which tracks the broader Costa Rican market, was trading at $34.07 and had already logged a 12% year-to-date gain. That momentum signaled that the market was rewarding the country's macro fundamentals. GDP of $358.7 billion in 2025, growing at 7%, and that investors were already pricing in a bullish outlook. John's purchase also tapped into 3 of the country's hottest thematic opportunities. 1. Renewable energy infrastructure. The condo's rooftop is slated for a 150 kW solar array, part of a government-backed push that promises an 8–12% annualized IRR for investors who hold the underlying power purchase agreements. 2. Ecotourism. The building will be managed by a boutique hospitality brand that markets green luxury experiences. Historical data from similar projects in the region show 10–14% annual returns on hotel-linked condo rentals. 3. Tech-enabled agribusiness. A portion of the development's common area funds will be allocated to a digital platform that connects local coffee growers with overseas buyers, an initiative projected to deliver 9–13% yearly ROI. By the time John closed, the Costa Rican peso was trading at 620 per US, a relatively stable rate that kept his dollar cost predictable. He also secured a 30-year leaseback arrangement with the developer, guaranteeing a minimum 5% yield on the unit's rental income, even if the broader tourism market hiccups. In short, John's condo isn't just a holiday home. It's a multi-layered asset that rides on macro growth, sector-specific upside, and a price point that undercuts the traditional first-world beach markets by a comfortable margin. If you're not ready to buy a slab of sand, the ILF, iShares MSCI Brazil and Latin America X Emerging Markets ETF, offers a proxy exposure to Costa Rica's equity story without the hassle of property law. The fund's YTD return of 41.12% dwarfs the S&P 500's roughly 12% gain over the same period, reflecting how the region's growth engine is humming. The fund trades on the NYSE, so you can add it to a standard U.S. brokerage account. No need for a foreign exchange broker or a local custodial partner. Simply search for ticker ILF, place a market order, and you'll own a basket that includes Costa Rican renewable energy firms, tourism operators, and agri-tech innovators. Credit rating agencies have nudged Costa Rica's sovereign rating upward to A/S&P and AA3, Moody's, a tier that sits comfortably above many of its neighbors. Those grades translate into lower borrowing costs for local companies, meaning the corporate bonds that sit under the ETF's umbrella tend to carry tighter spreads and more predictable cash flows. For the ultra-cautious, a dual-track approach works well. Allocate 60% of your LATAM exposure to the ILF ETF. Past performance does not guarantee future results. And keep the remaining 40% in a short-duration Costa Rican government bond fund. The bond fund can be accessed through global platforms like Interactive Brokers, which let you hold the securities in a U.S. dollar-denominated account, shielding you from the occasional peso swing. Finally, remember that the inflation rate of 3% in Costa Rica is only a shade above the U.S., approximately 1%. That modest price pressure keeps real yields from eroding, a rarity in many emerging markets where inflation can soar past 20%. The combination of solid sovereign credit, a high-performing equity ETF, and a stable price environment creates a trifecta that most global investors find hard to ignore. No investment is without its shadows. Here are the 3 real-world challenges you'll face when you dip a toe into Costa Rican assets, and how disciplined investors mitigate each one. 1. Currency volatility. The Costa Rican peso, while relatively steady at 620/USD, can still wobble on commodity price shocks or shifts in U.S. monetary policy. Savvy investors hedge by keeping a portion of their exposure in peso-denominated cash or short-term deposits, and by using forward contracts available through most major brokerages to lock in exchange rates for future cash flow needs. 2. Political headwinds. Although the country enjoys a A rating, the upcoming midterm elections could bring policy tweaks, especially around tax incentives for foreign developers. The best defense is diversification. Blend real estate stakes with publicly traded equities like ILF and sovereign bonds. That way, if a single policy change dents the property market, your equity and fixed income positions can cushion the blow. 3. Legal and title clearance complexities. Costa Rica's land registry system is modern, but foreign buyers must navigate a registro de la propiedad process that can take 30-45 days. Engaging a reputable local attorney, preferably one who has handled at least 5 foreign transactions in the past year, reduces the risk of title disputes. Additionally, insisting on a clean title clause in the purchase agreement gives you a legal exit if any hidden encumbrances surface. By layering hedges, spreading exposure across asset classes, and partnering with seasoned local counsel, you transform these risks from deal breakers into manageable variables. This is educational content, not financial advice. Takeaway 1. Costa Rica's 7% GDP growth outpaces the United States, giving you a faster expanding macro backdrop for both property and equity plays. Takeaway 2. A beachfront condo at US $6,700 per SQM delivers a price advantage that's hard to match in Miami, Sydney, or Cornwall, while still tapping into renewable energy, eco-tourism, and agri-tech upside. Takeaway 3. The ILF ETF's 12% YTD surge, paired with a sovereign rating of A, means you can capture the country's growth without ever stepping foot on a construction site. If you want to catch every one of these country breakdowns, hit subscribe. We post a new one every week. Grab the free Latam Investors Playbook at Latam Money Secrets. Com for deeper spreadsheets, model templates, and a curated list of brokers that support Costa Rican assets. Next week, we travel north to a market where coffee isn't just a drink, but a multi-billion-dollar export. Stay tuned for the hidden gems of Guatemala's high-altitude cacao farms.